The Altria Group, ticker symbol MO, was down 8.31% after reporting earnings. This boosted the dividend yield to nearly 10%. That is a massive yield for a reliable and growing dividend-paying company like Altria. They just raised their dividend by 4.26% a few months ago. Altria management reaffirmed their guidance of targeting mid-single-digit dividend growth. So why is the stock down so much? In the newly reported Q3 earnings, the company narrowed their earnings per share full year 2023 guidance to 1.5% to 3% growth. This is down from the prior guidance of 3 to 6% growth. This lowered 2023 growth seems to be one of the major factors driving down the stock. On top of this, the quarter was highlighted by positive developments in their key growth initiatives and some negative trends in their cash cow business segments. In this video, I'm going to provide an updated look at Altria's stock and the Q3 earnings report. Ultimately, I will share why I am buying more of the stock despite some negative news. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using the stock research tool I personally developed, which is available at dividenddata.com. Here you can do deep financial analysis on over 7,500 stocks, helping you find better investments. Link in the description and pinned comment. Overall, Altria revenue for Q3 is down 4.1% year over year. Year-to-date revenue is down 2.5% compared to the 2022 timeframe. Adjusted EPS for Q3 is flat year over year. Year to date, it's up 3.3%. GAAP EPS is up over 100% in both timeframes due to coming off of those large dual investment losses that we've discussed many times on the channel. Let's look at the positives and negatives of their specific business segments. First, their Enjoy acquisition is fully complete and they are starting to execute their growth strategy. This gives Altria a fully owned and controlled e-vapor product on the market. The company is using their existing supply chain and retailer relationships to expand the product footprint. They've grown Enjoy Ace distribution to 42,000 stores, now within all the top 25 convenience store chains by e-vapor volume. They expect this expansion to reach 70,000 stores by year end, representing 70% of e-vapor volume and 55% of cigarette volume. Altria is hoping the Enjoy business can become a profitable pillar of their smoke-free business segment. This is a long-term growth business for the company. Other growth businesses include on! nicotine pouches. Retail sales volumes for Q3 have grown 45% year over year to 29 million cans. This includes both higher trials and repeat purchases. Retail price per can has increased 52% for Q3 year over year. Market share of on! in the oral tobacco category is up 1.7 percentage points over the year to 6.9%. Both of these are pillar growth companies for Altria's smoke-free business. However, there are more mixed results in Altria's legacy businesses, most notably their largest business, cigarettes. Cigarette volumes continue to decline across the industry at above the historic rate. That said, the default expectation is already volume declines at this point of the business. This is due to less new smokers and price increases making the products less affordable. According to Altria, there are additional macroeconomic factors reducing demand. Examples include the broad-based inflation over the past few years, along with higher gas prices since late 2021. The gas prices factor is interesting since most of Altria's products are sold at convenience stores, which are often gas stations. Historically, high gas prices can lower sales of products inside stores. I actually heard this trend being brought up during PepsiCo's recent earnings, but they did not experience the impact. That difference is likely due to cigarettes being far more expensive than PepsiCo's snacks and beverages. On top of this, Altria estimates 1.5% to 2.5% of this decline is from cross-category movement from cigarettes to e-vapor, primarily driven by illegal flavored disposable e-vapor products. Altria is actively launching lawsuits against these companies and lobbying the FDA to enforce their regulations around these products. On the earnings call, the CEO emphasized, quote, These products are illegal, unquote. Altria is not allowed to sell these products, so why should they be available? So how is this trend directly impacting Altria's business? In Q3, the smokable products segment's operating income is down 2.5% year over year. Year-to-date is up 0.2% at $8.14 billion. Margins are up 0.9 percentage points to 60.1%. Their leading product, Marlboro, increased retail share year-over-year by 0.3 percentage points to 42.3%. Specifically, the premium segment market share for Marlboro has grown to 58.9%, up 0.4 percentage points. This is the cash cow product for the company. Think of it like Coca-Cola for the Coca-Cola Company. Marlboro margins and market share are growing. However, Altria saw its cigarette volume fall 10% year over year. This is greater than the total industry decline. From that, you can infer that premium is declining at a higher rate than discount. Again, this emphasizes that affordability is a large factor in the decline. The one bright spot here is that they saw John Middleton cigars grow 4.2% year over year in quarterly cigar volume. Again, smokable products are Altria's largest business and the cash cow. Next up is oral tobacco products. Despite the great performance of on! nicotine pouches, the retail share here has declined from 46.3% to 42.1% year over year. This is primarily due to a decline in Copenhagen and Skoal. Consumers seem to be preferring the nicotine pouch products, with Zyn becoming a smashing success. It seems to be a far more profitable business too. Oral tobacco operating income has grown 7.1% year over year to $455 million for the quarter. Margins have grown 2.9 percentage points to 69.3%. A large amount of this growth seems to be attributable to on! That will make this segment a growth business for the company. Say what you want about Altria, it produces a lot of cash. They use a high percentage of this money to reward shareholders. This is through both buybacks and dividends. They returned $1.9 billion to shareholders in Q3, $1.6 billion from dividends, and $300 million from share repurchases. There is $268 million remaining on their current share repurchase program, which they expect to complete by the end of 2023. Altria just raised the dividend 4.3%, which marks the 58th dividend increase in the last 54 years. For some of you who are new to the company, Altria spun out Kraft Foods in 2007 and Philip Morris International in 2008. That accounts for these large drop-offs you'll see in the graphs. In reality, the company has never cut their dividend and is in the elite category of dividend kings. Currently, the dividend payment is sustainable. It has a payout ratio based on free cash flow of 80%. It stays in this high range as the company is mature and committed to returning cash to shareholders. The 5-year compound annual growth rate of the dividend is 4.14%. This seems likely to continue with the company's guidance of mid-single digits dividend growth. At current stock prices, the Altria dividend yield is 9.98%. That is very high. I personally think this is a great time to buy the stock. The company is trading at 8.7 times annual free cash flow. Even using GAAP EPS, an often unreliable metric, it's only a 10.3 PE ratio. Altria continues to make more money for shareholders over the long term. Non-GAAP EPS grows reliably year after year. With this performance likely to continue, it seems obvious to me that Altria is one of the best high-yield dividend stocks you can buy. Following the 8.31% stock price reduction, I bought 40 more shares at an average cost per share of $40.68. I will continue buying more as the stock price declines. Currently, I own 468.8 shares of MO. With dividends reinvested, my cost per share is $39.48. This generates $1,837 in annual dividends. Altria is a long-term holding of mine that I think will have a fantastic dividend snowball effect. Of course, that's just my opinion, so be sure to do your own research before making any investing decisions. Please leave a like, share, and subscribe to the channel if this video provided value. Sign up for dividenddata.com if you want to use the research tool I've been showing throughout. If the software helps you identify just one slightly better stock, then it pays for itself. Here you also gain access to my portfolio tracker, which provides unique insights for the dividend-focused investor. Thanks for watching.